When it comes to marketing, especially, you need to know what that dip is. The example I always use in this conversation is if you're farming. It's a really simple example. What I tell an agent, if you're going to farm any specific area, farming, if you don't know what that is I pick a geographic territory and I decide I'm going to communicate to all the homes in that geographic territory, typically via email, or I'm sorry, via mail, postcard, that kind of stuff. And I'm going to do that consistently. That's a really good example of understanding the dip in the ROI. Typically with marketing, if you cannot invest what it's going to cost to do that on a monthly basis for a year with a very limited expectation of a return, you should never start. That is one of those things that it takes a lot of time for the momentum to build up and the results to take place, right? So if you don't understand that, you put money in and then you get frustrated and you back out of it. So it's a really good example of understanding the dip before you go in. End of the day, the thing that has the shortest dip is lead generation. If I proactively go out and talk to or meet more people, I'm going to get to the end result faster. And regardless of which one we're talking about, you have to know and understand your ROI. What's my return on investment for the thing that I'm doing, right? So again, if you're going to lean into any kind of a marketing strategy, you have to have a reasonable expectation of what is the dip and what is a reasonable ROI so that you can hold that investment accountable. And again, I always go back to, you should be running lead generation based and marketing enhanced businesses. Now, typical expenses and deductions, occupancy and home. So a couple of really simple things. One, we have different ways in which we can write off either our physical office and or for those of us who have home offices. Occupancy and home office. One, if we do not want to keep records, instead of keeping records of all of our expenses, you can deduct $5 per square foot for your home office up to 300 square feet. For a maximum deduction of $1,500. If you don't want to keep records, that's the way your home office is going to get deducted. Now, the other way to do it is you actually keep all your records. If your home office is 1/10 of the square footage of your house, you can actually deduct 10% of the costs of your home, i.e. your mortgage interest or your rent, your utilities, electric, water, gas, homeowner insurance, cleaning, extermination fees, right? All of those things become home office expenses, which you can write off the percent of those expenses that is equal to the percent of square footage that your home office takes up. All right, let's go auto real quick. Different ways we can look at auto. These slides are 2022, so yes, they need to be updated. In 2022, the rate for your per mile was 58.5 cents from January to June 30th. Then it was raised to 62.5 cents per mile. If somebody wants to Google that real quick, you can put it in the chat what it is today. So an example of how that would work, if you drove 8,000 business miles in 2021, you would multiply that number by the business mileage rate. As a self-employed individual, you can take a deduction in that example. If we did 8,000 miles at 56 cents a mile, it would be a $4,480 deduction, okay? The thing I want you to know about that, if you are ever audited, for self-employed people, the number one place that the IRS will find an issue during an audit of a self-employed human being is mileage. Because most self-employed individuals have a system for writing off their mileage, which is when they're sending all the paperwork to the accountant, they walk out to their car and they look at their odometer and they go, I think last year I had X amount of miles. That subtracted from my current odometer is 20,000 miles. 15 of that was work. And then we write off 15,000 miles. When the IRS comes, what they want to see is a record of all of that mileage. They want to see every single trip with some kind of a note to document that that was a business trip. Easiest ways to do that, for those of you that are an RE Profit user, there is a mileage tracker inside of the mobile app. Those of you who are not, the best tool I know is Mileage IQ. You can use that, and that will track your mileage for you so that you have a digital. If you want to go the Amish route, you just get a little pad and you keep it over the visor and you write down your mileage, right? So there's an Amish version and 2 high-tech versions, you pick. However, just know that's the number one area agents get in trouble during an audit, or self-employed people in general. So be smart, don't lose money because of that. The other method is your actual expense method, which lets you claim a business car deduction for a percentage of the total amount that you spend on the car. So that's your repairs, your maintenance, your oil changes, whatever, insurance, loan interest, registration fees. You actually take the hard costs of all that stuff and you write that off. Typically, the smartest thing to do is keep all the records that you need to so that you can give them to your CPA and they can tell you which method is the best method to get the highest deduction. All right, so now we're going to go to salaries. We ended up touching on this a little bit during the last call because people asked some questions about it and it was part of the content. So salaries, a couple of things to understand. There's a few different ways you pay yourself as a self-employed person. One is owner draws, i.e. my business made $100,000 and I took $50,000 out of it to use for personal use. In that scenario, is my taxable income. Taxable income is $100,000.
Yeah.
Right. So the businesses we run are pass-through entities, which means whatever they make, that's what we pay taxes on. Okay. So it's irrelevant how much I take out of it. If my business makes $1 million and I don't take a nickel out of it, I pay taxes on $1 million. If it makes $1 million, I take 500 out of it, I pay taxes on $1 million. Period. End of story. That is referred to as an owner draw. That is money the business made that I pulled out of it for personal use. It is irrelevant from a tax standpoint. Okay. Then there's another way we can pay ourselves. The other way we can pay ourselves if we, and now this requires some entity structure. If we are operating under an LLC, a limited liability company, we can choose to file taxes as an S Corp. All it is a piece of paper that we sign and our CPA sends it to the IRS and says we are an LLC who would like to file as an S Corp. What that allows us to do is pay ourselves a reasonable salary. That reasonable salary goes through a payroll company, just like it would if you had a jobby job. And all the appropriate appropriate taxes are taken out, just like would happen if you had a jobby job. Okay. Here's what that does. When we do that, that actually helps us save on self-employment taxes. So if you are not aware, and lots of people who are self-employed, they're paying it and they just don't know it. When you have a jobby job, taxes come out of your check. What you may or may not know, that's half of the taxes. Your employer is paying the other half. So when you are self-employed, you are both the employee and the employer. And what that means is you actually pay both. You pay the employer side and the employee side, and they call it self-employment tax. If you use this tax strategy and this entity strategy, LLC filing as an S Corp, it allows you to pay yourself a reasonable salary. Taxes are taken out of that. And the end result of it is you reduce the self-employment taxes that you're paying. Now, you have to have a conversation with your CPA. There is an income threshold where it makes sense to do this and it doesn't make sense to do this. So you have to have that conversation. The example on the screen shows how it could play out. $300,000 net profit, but I pay myself a reasonable salary of $50,000. I pay taxes out of that 50 grand of 7,415. And now my taxable income goes from 300 to 250 because that salary I paid myself is now an expense. So now that it's an expense, it shows up on my P&L as an expense, my profit and loss, and it reduces my taxable income. So now instead of 300,000 in taxable income, I have $250,000 in taxable income. The remaining taxes that I would pay would be 55,118. My total tax liability is 62,263, and my after-tax income is 237,737. Flip the script and go to the other side of the slide here. I don't do any of that stuff. I just file my taxes. I pay $84,000 in taxes plus $8,700 in self-employment. I have a $92,700 tax liability. My taxable income is $207,300. In this example, I signed a piece of paper, sent it to the IRS, had the correct entity structure, and I saved myself $30,000 in taxes. Is that a pretty good ROI on your time? The answer is yes, just in case you were wondering. Any questions about LLC, S Corp filing, self-employment? I got one hand. David, what do you got?
Matt, super quick. In the past, I know you're not giving advice, but you had made a suggestion that the number really needs to be like, was it like 200 or 250 or 300, like to sort of start to justifying? Obviously 100,000 doesn't make any sense.
Candidly, the only answer I'll give there is talk to your CPA.
Yeah,
Because I want to make sure A, you have the conversation, and B, they let you know, does it make sense today? And if not, when does it? So I'm going to punt that one to your CPA.
There's a question in the chat. In Connecticut, do you need a broker's license to have an S Corp?
Phenomenal question. Depending on the state you are in, it's not that you have to have a broker's license to have an LLC or an S Corp or file as an S Corp. However, in certain states, in order for your broker to pay the LLC has to have a broker's license, right? Because some state laws say a broker can only pay a broker, and then the broker pays the agent. So in some states, the LLC itself has to have a broker's license, which means the owner has to have a broker's license in order for your brokerage to pay the LLC. Now, I have been told that there is some workaround for that in certain states. Again, I'm not going to get into workarounds. Talk to your CPA about that. Leverage nepotism. So for those of us who have children, if you have children between the ages of 7 and 22, you can use this strategy to save money. The way it works, each of your children can be employed by your business and paid an annual wage of $12,000. $12,000 is important because it's the standard deduction amount for a single individual. Okay, so your business gets to take a deduction for the amount that you're paying your children, thus decreasing your taxable income. Okay, so you have 2 kids, you pay them each 12 grand. That's a $24,000 expense that you take on your P&L, and that becomes your children's income. Now, your children will then file their own tax return, and since they only made $12,000, they pay no federal income tax. Because of the standard deduction of $12,000, their income becomes tax-free. So you just put a $25,000 expense on your P&L if you have 2 children. That became your children's income, and their children's income will have no tax liability. So you just remove the tax liability on $24,000. Okay. You can also combine this strategy with IRA and 401k strategies in order to maximize it. An example would be if you paid them $12,000 each in salary, you could put $6,000 into an IRA that is deductible, and you can use their standard deductions to take advantage of the zero taxation at that income level. In that case, your business can take a deduction of $18,000 and it is all tax-free. This is a really good strategy for your children because there's a lot you can do with it. Number one, if they have expensive hobbies, when I went to say expensive hobby, you see how hockey came out? That was like a Freudian slip, I think they call that. But if they have expensive hobbies, an example might be, I don't know, horses, because that's a problem I have in my life. That's the hobby my kids chose. That becomes money that you can give to your children, and your children could use that money to buy their own clothes, pay for hobbies, and or you can take that money and put it into some kind of an IRA or 401k for them, which, by the way, this isn't exact math, but like if you were putting, I think it's $1,000 a month into a retirement fund for your child. If you started, I think it's at age 15 and continued it to age 25, stopped then and never put another dollar in based on average returns and compounding interest, I think they would have something like, I think it's like $2.7 million by the time they're at retirement age. And that's if they stopped. So it's a great opportunity to set your children up if you like them enough to do that. Any questions around that? Good chance I might not be able to answer in any more detail, but go ahead, Lindsay.
Okay. On this strategy, it says for your business, is that only if you have an LLC or if
Nope.
you don't? Okay.
Nope, you can be self-employed. Yep. And by the way, you can Google it, you can talk to your CPA, right? Either way, if you Google it, talk to your CPA, right? That's going to MedMD and like diagnosing yourself. Like you can get some ideas there, but you might want to seek professional also. There's a lot of things they can do, right? Like they can, I don't know, stuff envelopes. They can do your SEO. Like our kids might be better at that stuff than we are. They can help with your social media. Like they might be able to wash your business car or clean your home office. You can come up with a million things that they can do. You do have to justify it. You do have to record it in case you're audited. What are they actually doing? So you want some records in case you get audited that it's valid. Okay. Tara, what do you got?
I'm curious if you could do this with like a retired parent. Does
I've
it have to be a
never,
child?
I've never heard of that, but maybe. I would ask your CPA. I guess the question I would have, other than helping to give a retired parent some income and some revenue, I'm not sure if I can connect the dots back to like where it becomes a tax strategy for you. Like with your children, where typically the strategy makes sense is you're using it for one of two things. You're reducing your taxable income, and then you're using the money to pay for things you would pay for anyways, but the difference
Right.
is, right, for every 50 cents you would have had to pay for things for your kids, you now have a full dollar.
Yeah.
Or you're
no.
taking that money and putting it into an investment for them that is then going to compound and set them up for the future. So my
Yeah.
question would be, if you're doing it with a retired parent, if you can, and I don't know, you'd have to ask a CPA, how does that connect back to,
Being beneficial.
yeah, to you actually saving on taxes? Does that make sense?
Yep. Absolutely. Thank you.
Yep. Susan, what do you got?
My question is, do you have to run that through your payroll company, or is that something that can be paid direct to your child's bank account?
I'm going to apologize and say that I'm going to punt that one to your CPA also, because I feel like it doesn't have to, but there was a reason that we ended up doing it that way.
Right, because I did do that. I did do a payment to one of my kids directly to their account from my business account for 2023. But now, as I've been working on what my tax strategies are for 2024, I'm thinking I probably should have done that through my payroll company since I have one anyway.
Yeah.
But I will circle back with my CPA.
Yeah, definitely. And by the way, it's a wonderful learning curve. Like all of a sudden your kids have to file taxes. Like just an interesting little side note, when I 2 moves ago, we were moving to another home and I was clearing out boxes, right? We all have those boxes that we've moved like twice and never opened. So I was going through those boxes, like, do I need to move these a third time? I found all of my tax records since I was a child. The first one, and yes, people can laugh at me and make fun of me. The first one was in pencil on carbon paper. It was a carbon paper, like in children's handwriting, filled out. It was hilarious. I was like, this thing is awesome.
That is awesome.
Yeah, but it's also a great educational tool for your kids if you don't just pay them, but you actually involve them in the process so that they understand it. They get to learn, right? When they get their first check and the taxes come out of it, they're like, wait a minute, what is this? And you're like, yeah, welcome to the real world. This is how it works, right? So it's also, again, a great education for them.
Matt, I don't have a 7-year-old just yet. I do have twin boys, though. What are some examples that you've experienced with having a record proof of the job that kids have done? What are some easy ways to keep records of that? I mean, a top punch card, or is it a invoice? What are some ways that
Sure, you could keep a log, you could take pictures. One individual that I know, if they do presentations and they have their son do the introduction at all of their local presentations that he does. So the son will come out and introduce his dad. And then like at the break, his son comes out and like talks a little bit about like what he's learned growing up with his dad, and they video it. So if they ever get audited, they're like, yeah, no, he partners with me on my seminars and presentations. Here he is doing it. Right. So whether it's a log, whether it's photos, videos, you just want to have some evidence that, again, it only matters when you get audited. But if you do, you want to be able to go, no, here it is. I have a record of everything that they did.
Duly noted. Thank you.
Cool. All right. The next piece is both a tax strategy and a wealth building strategy. So we're going to talk about investing for cash flow and massive deductions. So this one we also touched on a little bit last week. So understanding the power of depreciation. I'm going to go through the beginning of this quick. Again, at the end, I'll pause for questions. Most of us, I think, understand what depreciation is, right? If we have an investment property, we're allowed to pretend that that property goes down in value. So example, we buy a property for 200,000. The land is worth 75. That means the improvement, which is the part that we can depreciate, is worth $125,000. If that's a residential piece of real estate, you divide that by 27.5. And it tells you how much you get to deduct on an annual basis. So the way to think of it is the IRS puts an expiration date on real estate of 27.5 years. So in this example, we could deduct $4,545 each year. Okay, that's on top of our cash flow. That's on top of our tenants paying down our mortgage. That's on top of all the other advantages of owning real estate. Okay, there was a passive loss rule that was enacted in 1987. I'm going to give you like the bartender's version of this so we don't get lost in the weeds. Basically, what it said is there's different kinds of income. There's active, portfolio, and passive. And this rule says you can only shelter active income with active deductions. Okay, so example would be if you take, active losses. So if you are, let's say you're a cop, okay? You're a cop, but you also own real estate. You actually can't, they limit your ability to reduce your income from being a police officer with your income from your real estate investment because they look at them as two different types of income. One is active, one is passive, okay? The reason they made this rule is there was a lot of really wealthy people, which by the way, by the time I get to the punchline of all this, it's happening right now. And it's a huge opportunity for you and all of your clients. But the long and short is there was a point in time in which very wealthy people, because of depreciation, were just buying all the real estate that they needed to completely wipe out their taxes. So super wealthy, you go to your CPA and you say, I make X amount of money. How much real estate do I have to buy in order for the depreciation to wipe out all of my taxes? And they would go out and buy real estate based on the deduction rather than the cash flow or appreciation. Okay. The government looked up at some point and said, that's not what we meant. That's not what we intended to happen. And they changed the rules. Okay. Now, here's the part that matters to you. They modified that rule to say if you're in a real trade business, then you are allowed to eliminate as much of your active income as you possibly can through depreciation. The rules around that are the definition of you're in a real property trade is you perform at least half of your personal service for the year in a real property trade. You work at least 750 hours a year, which is laughable. Most of us do that in a month. That equates to 15 hours a week in a real property trade. So rule was modified in 1994, and it eliminated that cap and basically said, as long as we meet those criteria, we can write off as much of our income as we can possibly accumulate depreciation. So what that means is everybody on this call who meets those three criteria, if you can go out and accumulate enough real estate that produces enough depreciation to cover all of your income, you would no longer pay taxes on any of your income. Now, it gets better. There's a thing called cost segmentation. We talked a little bit about this on the last call. It predominantly was used within commercial real estate, but it can also be used within residential real estate. We talked about that 27.5 years essentially being an expiration date. Yes. That is an average of the expiration dates of all the different components that make up the improvements to the real estate. I just saw myself and I felt like a cheerleader. That was really weird. I'm going to never do those hand motions again. But that is what it is, right? So each individual component has separate expiration dates. You put them all together, they go, let's call it 27.5. Cost segmentation is I break it up into pieces and I go, okay, well, the utility portions, my boilers, my HVAC, whatever, that has a 20-year life expectancy. The driveway has a 20-year, my garage has a 20-year, my landscaping has a 10, my appliances have a 5. I separate it all out. And what they do is they put the value of each of those components in different buckets and they allow you to accelerate your appreciation. What that means is I don't get more money, I just get more money now, right? It speeds up, which by the way, whether we're talking about building wealth or debt, it's the same concept. It's a snowball. It's a lot of little things over time that move us away from wealth. And it's a lot of little things over time that move us towards wealth, right? This is one of those little things. It'd be easy to look up and go, well, it's not even any more money. What's the point? Well, the point is to keep more cash now so that you can put more cash into investments that produce more cash and more deductions, right? It's a snowball. Okay. So that's cost segmentation. So there's a thing called bonus depreciation. Bonus depreciation is started in 2022. Currently, it sunsets in 2027. There is a bill in the House right now that, depending on who you ask, has bipartisan support that would reintroduce this back to the 100%. This is what bonus depreciation says. We already talked about we can break up the components and we can accelerate our depreciation. So again, use appliances as an example. Instead of depreciating my appliances over 27 years, now I can take the depreciation over 5. My roof, instead of taking it over 27 and a half, I can take it over 20, right? We're just accelerating it. What bonus depreciation says is you get a cost segmentation and all of those buckets, other than the 27.5, if it's in any of those other buckets, I get to take a lump sum deduction for the total at once. At once. A real life example, $325,000 property, 20% down, you're putting whatever that math is, close to 70 grand down on the property, cost segmented out, bonus depreciation, $80,000 lump sum deduction. That is a real life purchase that took place, had a cost segmentation. That was the deduction. That's an $80,000 deduction you get to take in once. That's $80,000 of your income that you do not pay taxes on because of that strategy. Now, here's the other beautiful thing. You can go back and amend. So if you purchased an investment property from 2022 to now and you did not do this, you can go to your CPA and you can file an amendment to take the deduction. I have yet to speak about this in front of a group larger than 10 people where there wasn't someone in the room who didn't know about this and bought a property. They just made 20, 30, 40, 50, 80, who knows how much money sitting in that room when they realized, holy cow, I bought a property in 2022 and I didn't know anything about this. Now they can go back and amend it. Okay. Here's what you do have to know. You do not want to do this on a property that is not a long-term hold. If you are not aware, when you depreciate real estate, when the day comes that you sell that real estate, assuming you don't do it through a 1031 exchange, they're going to recapture the depreciation. So if you turn around and do that deal that I just said, and you sell it 2 years later, you now have this huge deduction you took that is going to get recaptured, and it's not going to work. Right? Because again, you didn't get extra depreciation. They just allowed you to take a huge chunk of it up front. But if I were to sell tomorrow, now they have to recapture all that depreciation that I took. Okay. So it's a long-term strategy. You don't do this on a property you're holding for 2 years, right? It's something that's going in the portfolio and you're going to keep long-term. Now, last piece is this is currently a window that is closing. Started in 2022, you got to take 100%. 23, you got to take 80% of that amount up front. Then it goes 60, 40, 2026, it's 20% up front. It sunsets in 2027 and goes away. Once again, there's a tax bill in the House right now. Part of what is in that tax bill is reintroducing this at 100%, right? So that window may go all the way open again. Now, you should be looking at this strategy in a couple of ways. One, this is something I can implement myself to build wealth. 2, this is something I need to be communicating to my clients so that they can build wealth. I just met with an investor for one of my agents. It was me, one of my agents, and their investor client who has a chunk of funds that became available to them. And they were going to invest that into a building. And we sat down and I showed them what they, instead of taking all that capital and going into one building, I showed them how they could leverage multiple different strategies to A, wipe out all their taxes, and B, purchase multiple properties. And I did a 2-year kind of pro forma on a whiteboard for them. Like if you go this route, this is what your end result is. If you go this route, This is how you've multiplied that capital over a 2-year period. And the gap was massive, right? So what we do and don't do with our money matters a lot. This is a really important strategy. You should be creating investors with this strategy. You should be becoming an investor with this strategy. You should be marketing this. We all know the term MOFR, make offer for immediate response. You can put this into a MOFR, right? Put it on social media, send it out to your clients, right? You can create investors by educating people on this, okay? Questions about depreciation and bonus depreciation, cost segmentation. Lindsay, what do you got?
If my investor bought their property in 2023,
Mhm.
does it start with the 80% and go down, or does that graph shift to the right and it starts with 100?
It would be 80.
Okay.
Because basically what you're doing when you make an amendment like that, you're going back in time to say, I didn't realize I missed this deduction, and I'm now going back and amending the tax return to take the deduction now. Which, by the way, personally, I think is really important to pay attention to these things. There's lots of reasons why you have to do amendments to your taxes, especially right now with all the things that have happened over the last 4 years with government programs and all this stuff. A lot of them required you to do amendments to previous tax returns. But if you can stay up to date on this stuff so that you're executing on it in the moment rather than having to go backwards, I personally feel like you're throwing less red flags to the IRS and nobody wants to be audited. Now, that being said, I would not avoid recapturing a tax opportunity like that over fear of being audited. But I'm also pretty comfortable that if I get audited, I'm in pretty good shape, right? So again, the more you can stay up to date, the less you have to rewind in order to take advantage of these things. But it is pretty amazing that you can go back if you're unaware of it. I'm going to go ladies first. How do I pronounce it?
Edie.
Edie. Okay.
Hey.
Edie, I love that last name. I wish
Thank
my
you.
last name was Hammer. That'd be awesome.
It comes in handy every once in a while.
Yeah, I love it.
Who does the cost segregation study? Who do we go to for that?
Great question. So there's a couple different ways you can do it. It's basically a special appraisal, right? So you can contact appraisers and say, hey, are you able to do cost segmentation appraisals? There is also like, I don't want to say virtual, but virtual services where you can submit all the information and they do the analysis and then provide it to your CPA. It's your CPA who files it, but it is a third party who will do the cost segmentation. I will dig up the name of like I'm going to say virtual one that you can go in and submit all the information. I can't think of it off the top of my head, but I'll remember it and I'll have Cassie get it out to you guys. So it's either that or call your local appraisers, the people you know, and say, hey, can you do a cost segmentation or do you know somebody who can? There is a cost to it, obviously, but if you're able to capture a deduction like that, then it's not an expense, it's an investment, right?
Thank you.
You're welcome. David, what do you got?
Sorry, two things. One, you talked about it being long-term. Is the danger if it's within less than the 5-year term, or you're even saying like that 27-year for like the driveway and the roof and those longer term things on the recapture?
So is the question, how long do I need to be holding this property in order to take advantage of this? Is that the question?
Where the recapture doesn't turn around and hurt you, if you will.
So two answers. I wouldn't do it unless I was keeping it for the foreseeable future. Or I have a plan to sell it through some other tax mechanism like a 1031 exchange. If you do a 1031 exchange, then the taxes, the capital gains on your profits, and the bonus depreciation recapture rolls into the next property. So if I do a 1031, I take that tax liability and that recapture, and I pull it out of that house and I put it in a new one. Now, as that one is depreciating, I now have the depreciation and the tax liability for two houses sitting in one. If I flip it again through a 1031, I now have recapture and taxes for three houses sitting in one. So there's strategies that you can do it. Long term, if you're really getting into buying properties, you gotta get some smart people around you and talk about the exit strategy. Because at what point am I going to exit and cash out? Or is this all going to land in some kind of a trust that we just hold for generations? In which case, I can actually push those taxes for long periods of time, potentially forever, if I properly set it up. So again, I would say you're holding it for the foreseeable future. At some
Perfect.
point, you're going to pay the bill if you sell and you do it outside of an exchange. The hostess with the mostest deduction, I like to call it. It is the Augusta rule. So this is what the Augusta rule says. It's section 280A whatever, who cares what it's called, of the Internal Revenue Code, allows a homeowner in any income bracket to exclude up to 14 days worth of rental income from their taxable income. This is renting out your primary residence. Okay, you can't do this with Airbnbs. You can't do this with, your regular rental properties. This is, you can actually rent out your home 14 days a year, tax-free. Now, how do we use that? Let's say we have a team. Well, if I'm going to pay for a venue to have a team event, rather than paying for a venue, I can charge myself what is reasonable. So you have to look at the market and go, what would it cost me for a similar venue? And you can charge yourself, right? So your business, or you can bill your business to rent your own home to have a meeting. Client appreciation. I could rent a venue, or if I'm comfortable allowing those people at my home, I could throw a client appreciation at my house, and instead of paying a venue, I can now pay myself. That becomes an expense to the business. The money goes into my pocket, and it can be tax-free up to 14 days. Right? So I would argue if you're not a person who likes to throw parties, you just got a really good reason to become a person who likes to throw parties. I like to throw parties. Specifically, I like to throw 14 parties a year. So it's just another opportunity. You take all these things and you start implementing them, all of a sudden, the money you're making is the same. The money you're holding on to is drastically different, right? Now, by the way, one small caveat. If you're going to leverage a strategy like this, be smart, talk to your insurance company. You have homeowners insurance. You can usually get a special events coverage. Sometimes it costs nothing. They just literally send you a document saying that you're good. Sometimes it's a small fee that they'll charge you, which, by the way, you can roll into what you bill your business because that's an expense. So whatever you're going to charge, you can say, well, that extra coverage to make sure if somebody falls, gets hurt, and tries to sue me while they're at my property, that becomes part of what you bill your business because that's your own overhead. So make sure if you're going to leverage a strategy like that, you also protect yourself. Okay. Ahas and questions.
The chat, can you use bonus depreciation with a 1031 exchange purchase?
Yes. So in a 1031, you would be selling one property. You would be rolling that all into a new property. And on that new property, yes, you could take bonus depreciation. So Lucy, then Stephanie.
I was going to say a couple of ahas was just how much use I could get out of like having two kids. I could save a ton of money just by using my kids to pretty much, and also just help them create wealth for them as well. Just kind of like really help them get off to a really good start. That and how I can use all of the information that I learned today to educate my clients and become a real estate consultant, not just a real estate agent. So those are my ahas.
I love that. And two things you can do for your kids that are huge. One is, if you can do it, get them a whole life insurance policy. There's reasons we're not going to talk about it right now because we're out of time. And two is, set them up to be able to pay them through the business if you can. And if you can, put some of that into an investment for them. I mean, you can literally set them up where it is not a question of whether or not they will be millionaires when they retire. They just will, short of an apocalypse, which I don't like saying anymore because I used to say we needed a zombie apocalypse in order for this to happen. And then we had a pandemic and I was like, I'm going to stop saying that. But anyway, short of something we've never seen, it wouldn't be an if, it would just be a yes. because math. I think I saw one other hand.
Yeah, Matt, I had an aha here. My wife and I purchased 2 investment properties in 2022, and I've been meaning to do some research on the cost seg studies. And so this, for nothing else, was worth it to make.
There it is. There's always one. Love it.
A question I have on RE Profit. I've been a user for over 3 years now. Love it. And I noticed every single year the budget to performance is super spot on. But I noticed whenever I added in my personal, my income that I was paying myself, my salary, it would then throw off all the numbers. So am I really that out of budget, or does it automatically find a way to factor that in or not? How does that, what's the best approach to kind of using that?
Yeah, so here's what I'd say. When you're looking at the MREA budgets, those budgets don't factor in you paying yourself. So that's going to
look at it as a transfer, because when you change it as a transfer, it doesn't really show on your P&L, but
that's right. Yep.
Yeah, that's what I did to creatively circumvent that from being added onto my budget. My
And here's the 2 different school of thoughts. If you are not paying yourself through a payroll company, if you are, you want that expense to show up there 100%. If you are not, there's 2 schools of thought. One is, it does not even show up on your P&L. Period, end of story, because it's not an expense. Some people will coach you that you should put it in your P&L because what it represents is the person you're going to have to pay to do your job someday if you ever want a 7th level. If you do that, you have to make sure your accountant is aware so they extract that from the actual filing, right? Most of the time, like my advice is just keep it off the P&L so you don't have to risk accidentally filing, right? But those are the 2 schools of thought.
10-4, and I don't, yeah. I'm
it.
Got it. 10-4. I'm going to keep it as is for sure.
Exactly. From a tax standpoint, it shouldn't be on your P&L.
Perfect. Thank you.
Yep. All right, everybody. So we'll be back next week. And we'll be back every week for as long as you all keep showing up and getting value out of it. Again, I'm going to ask for the same thing every time. If this is valuable for you, bring a friend next time. Let's impact more people. Okay. So if this is valuable, come back and bring a friend. All right. Love you guys. We'll see you.